me see if I have Jean Ergas, Tigress Financial Partners on the line. Jean, do you hear me?
I hear you very well, thank you.
Good evening, Jean, and thank you for joining us tonight.
My pleasure.
Well, Jean, as we've heard, Theresa May tried to convince lawmakers in her Plan B, but it's not really a positive, the reaction, because we followed the discussion between the Parliament and Theresa May. So what we felt is that they do not really agree on her Plan B, and there are not really many differences compared to Plan A. Where are they heading to? Where is UK heading to?
That's a very good question. I really always thought from the beginning that, in fact, this Plan B was going to be a Plan A slightly tweaked for two reasons. First, because there are certain issues which simply cannot be accepted by many of the lawmakers, and that is the customs union or some form of single market. This will go dramatically against everything that the Leave contingent voted for. And secondly, I would say very explicitly, it's because the EU is the one that also has to decide. This debate has hitherto been framed as simply the UK lawmakers speaking to each other, coming to a conclusion, and then going ahead and voting it. There's something wrong here. There's a very important person here, the other tennis player, the EU. We are playing a doubles game, so to speak. And I think we have to be in sync. They have to be in sync. And they are not in sync. So I think it's really going to be extremely difficult. The real issue, of course, is more than simply voting and several times, like some people have proposed, let's vote type battleships to see where we get the hit and where we get the most consensus. The real problem, our issue, I think, was the second referendum issue. And now this seems to have been ruled out. I think the fear in the UK is that the second referendum would undermine a basic belief in a majority rule, the electoral process, and would set a dangerous precedent. Now, that said, it seems that there's a 12% majority now, and the majority of 12% over what is required for the Remain contingent. Many people have rethought their position. But there are some constitutional issues here, I would imagine, and some difficult issues of procedure. So I think at this point, the best that can actually happen is that somehow, A, these people wake up to the fact that the deal is better than no deal, and that no deal will lead to tremendous amount of disruption, and it will lead to an immediate crash in housing prices. The reason I'm talking about the housing prices is very simple. That in the United Kingdom, a house is most people's pension plan, and if that goes, they are dead. So I think there's going to maybe be an attempt now by May to go to Brussels, come back with a little bit of a tweak, maybe some slightly different side letter wording for the famous Irish backstop. Remember, the Irish said they are not going to do a bilateral deal. The Irish are not going to conclude, so to speak, a separate peace with the UK. So now it really is in the hands of the EU. I think at the end it's going to be, listen, it's this or, guess what, either no Brexit, which I think was very difficult, or no deal, and you will immediately see a large part of your wealth fritter away or collapse overnight.
And on the other hand, as a senior economist, what are you mostly concerned about? What do you believe, which is going to be the sector that is going to suffer the most in case of hard Brexit?
Well, I think they're all going to suffer. I will tell you immediately. The one I think is really going to get slammed is the domestic economy. Okay, let us look at the distinction between the external economy and the domestic economy. First thing that's going to happen is that there will be an absolute block, I think, on domestic investment. And this is obviously going to cost jobs. It will also stop the wealth effect. It will also hit the housing sector, which is very important as a consumption driver wealth effect. Two, there's going to be a devaluation of the pound. This devaluation of the pound will result in imported inflation, which will further squeeze domestic incomes. So we're going to be seeing this acceleration effect of increased inflation, falling house prices, falling wealth effect, shrinking economy. Who will come out maybe the best of it? Possibly companies which have extensive earnings from abroad and which they can repatriate at a far more advantageous FX rate. But I think we're going to be looking at butchery. on the internal front. This is going to be very, very, very complex, because then something else is going to happen. To counter the inflation, the Bank of England is going to have to raise interest rates, which is going to disproportionately hit those smaller companies which cannot access the capital markets or international bond markets, but are reliant on bank financing, with a very quick pass-through from Bank of England decisions. So I think it's not an attractive scenario. Now, I'll put it to you very simply, as we have often said. There are two choices now. One is managing decline, which is some sort of deal Brexit. The other is disruption and collapse, which is the no-deal Brexit. There are people who claim that you can actually have a no-deal Brexit without disruption by a series of side letter agreements on essential services. This in no way guarantees the smooth functioning of the British economy. You will be managing by exception, and there will be areas of non-clarity, which could be quite dramatic, such as, for example, in the pharmaceutical sector. So I think that in the end, people, I hope, with my hope, will come to their senses and say, look, let us choose the lesser of two evils. Second referendum, it's always there, and the general election issue has not gone away. So remember, I think some people might actually think at some point, maybe I'll accept this deal if not I'll end up with Jeremy Corbyn. I was in the UK in the 1970s, and believe me, I saw what the radical Labour did. So it's a sobering thought. I think it's a very difficult situation.
Well, Jean, I would like to ask you another question. Currently, the sterling against the dollar is literally rallying. It's up by 18%. It's at 1.2895. It's one of the highest levels. Are you surprised about that?
Sorry, can you repeat your question? What currency is?
The sterling against the dollar. Are you surprised?
Sterling, okay.
Are you surprised
yes,
it's currently
sorry.
currently rallying?
Yeah, no, sterling. I'll tell you about sterling. First of all, sterling, I was in the UK exactly a year ago, and sterling was 140. Okay? And the dollar was roughly where it is today versus other currencies. So in fact, if we're looking at sterling in those terms on a one-year basis, exactly, we have seen a sharp depreciation of the pound. The sterling has come back from below a 125 level. What the market tends to be saying in FX is, listen, we think there's going to be some kind of a deal here at some point. We may even, now the other question we didn't talk about was the extension, and Mrs. May is adamant there's not going to be an extension, but we know how politics is. And the market is saying, look, we're going to come to some kind of a deal. The market has ruled out, I think, erroneously, the prospect of a no-deal exit. It's like people ruled out that Lehman Brothers could go bankrupt. I myself was in Monte Carlo at a very big risk conference just before they went bankrupt. Nobody solemnly assured me that this was impossible, and I expressed my doubts that they were right. So I think this is basically it. What I think is interesting is if you look at the UK bond market, okay, and that, in fact, people are buying longer-dated bonds. And what this tells us is that they believe there's going to be a lot of disruption in the short term. This is a classic sign of country risk increasing. Okay, so I think this is a very important point. We're looking at two different markets. We're looking at the currency market, and we're looking at the UK gilts market. And the gilts market is signaling danger, and the currency market is saying, well, look, in the end, they'll muddle through. So I don't think that sterling is that strong, quite frankly. If I think it was 151 when this happened, it hit a minimum of about 119. I think there was a flash crash. It hovered around the 139.40 for a long time. Now we're at 128. We're still below 130. I don't think that sterling is that strong. I still think that sterling, compared to then, I still think that sterling is not taking into account the risk of a no deal.
Right, Jean, I would like to focus your attention on the US because there is a lot going on there. We are at the 13th day of a partial shutdown. It's more than a month now that more than 800,000 government workers are not taking their salaries. First of all, I would like to ask you, Jay Powell said that he would be worried for the economic impact if it lasts till 1st of March. But are you starting to be worried? Because from what we've seen, there is no really much of green light from the Democrats regarding the border wall. So what is your opinion? Are you already starting to be worried about the impact on the US economy, and do you believe those people are going to be paid sooner or later?
Look, I've been worried all along because I started from the assumption that Trump is campaigning. What is actually taking place in the U.S. now has very little to do with the border or non-border in and of itself. It has a lot to do with getting reelected. When the people decide that they need to get reelected, economic rationality goes out the window and political rationality takes its place, and this is a very different game. I think that there are some noises now of maybe coming to some vague form of agreement. As regards economic impact, I'm convinced that there will be one. I think it could be up to 1 to 1.5% for the first quarter, not only because these people were not paid, so they did not receive the checks, so they could not buy things, but also because of the fact that a lot of business must transit through government services or checks, and these have not been done, and therefore this has slowed the course of business. So I think it's a very important point. I think, yes, it could have an impact, but I think the real point will be the loss of credibility. And to finish, I would say, yes, I was saying before, I think there are some vague noises we are hearing. It is based on semantics and not on substance. It is based on saying, well, let's not talk about a wall, let's talk about barriers. Let's maybe give you another $1 billion, but we'll tuck it in somewhere else. And there it is. I think that Trump has realized that Nancy Pelosi is a very tough cookie, and that it will not be easy to push these people around, and that in fact people are now starting to think, look, whose fault is it that this thing is just dragging on? So I think, yes, there's going to be an impact. The question is, will there be a snapback? This is it. Government shutdowns have tended to have an impact, but had a very quick snapback. This one has been long. How quick will the snapback take place? This is the issue, and I think we may have to wait. I am a believer that growth is slowing globally, and it will slow as well in the U.S., and this is not helping.
Well, Jean, on the other hand, we had last week the bank's earnings season, so there was a little bit of relief for the banking sector, because I say relief because it closed 2018 in the negative territory. Most of the banks posted positive profits and also revenues, but I want to underline that Citigroup fixed income revenue dropped 21% year over year to $1.94 billion. And most of the banks, most of the counterparts of Citibank had a very low fixed income. So why is that in your opinion? And first of all, and secondly, how do you interpret this data that we had?
Look, I think the first point is this. Let us look at the banks as an indicator of the economy as such. I don't think they are. I think that the banks are playing to a very different, marching to a different rhythm, which is regulatory, and it's also based on the shape of the yield curve. And that's the traditional, what can do, and the profitability of the basic lending business. When we start looking at things such as fixed income, we are no longer looking at traditional banking business, we are looking at trading business. And trading business can be influenced by a number of factors which have very little to do with economic reality. It can be, for example, a drop in volatility. It can be a shift in asset allocations, a shift in investment strategies. So I think I would not look at the banks so much as the indicator. The banks are interesting only in as much as a very poor performance from a bank or undercapitalization or a very sharp rise, unexpected in bad loans, could be a monitor signal for systemic risk. But let us not confuse the banks with the cyclicals and with the big companies which are a pulse of the economy much more. I think the banks are neither here nor there and tell me very little about the real march of the global economy. I am much more focused on the macro cyclicals, point of sale, commodities, purchasing manager indexes. I think that's where the key is.
Well, Jean, let me ask you one last question because we are unfortunately out of time. China's economy grew 6.6% year over year in 2018, the lowest pace in 28 years from 1990. Do you think 6% growth is still feasible for Beijing in 2019?
Look, the question is, what is the real growth rate in China? I do not believe it's 6%. If we strip out basically artificial growth, which is being financed by bad loans, i.e. loans from the government which will never be repaid, and which are basically fictitious companies, I think growth is more probably around 2%. So I think that's how we have to look at it. The growth rate official is what the government wants it to be. The government will get that growth rate at what cost? Of increasing the bad loans and creating a problem in the credit system. I think that the country is slowing. I think that, in fact, we are seeing the creation of the first wave of the middle class. I think this process is coming to a gradual halt, and I do not believe that China will save the world again. I think we have to get used to the fact that there's going to be a soft landing at some point in China, and this growth rate will naturally decline, and they also have demographic problems. Therefore, we cannot look to the Chinese consumer as we once looked to the U.S. consumer to be our rescue.
Right. Thank you very much, Jean. Ergas, Tigris Financial Partners. Thank you very, very much for joining me tonight.
It was a pleasure and an honor. Thank you.
Good evening.
Bye. Cheers.
Well, we are going for a short commercial break, but we are going to be back in few minutes.